QQQM crushed VV with a 135% return versus 87%. That's a 48-point gap, showing growth's massive advantage over stability. Now let's shift gears and look at QQQM's 108% crushes, VV's 94%, over 5 years. Tech stocks clearly dominated this period, despite the sarcastic headline. But here's where it gets interesting. Nearly identical performance here. QQQM's 18% edges out VV's 17%. But we're talking a razor-thin difference over 1 year. In plain English, QQQM is like a Formula One car, blisteringly fast over 3 years. VV's the endurance racer, steadier over longer distances. Same race, different strategies, pick your pace. QQQM's sharp ratio of 1.4 means you're getting solid returns without taking excessive risk. That's the efficiency sweet spot investors hunt for. Here's where the story takes a turn. VV's 1.2 sharp ratio is solid, but QQQM's delivering better returns for each unit of risk you're taking on here. Let's break this down further. Both funds hit 0.6 for 5-year sharp ratios, dead even on risk-adjusted returns when you zoom out over time. In plain English, the sharp ratio's your efficiency meter. Like mechanical leverage, you want maximum return with minimum risk. It's about getting the most bang for your buck in the investing world. Now for the real question. QQQM's Sortino ratio of 1.9 shows solid downside protection. You're getting rewarded well for the actual risk you're taking on the downside. Let's dig into the details. VV's Sortino ratio of 1.6 is decent, but it couldn't shield you from losses as well as QQQM did during downturns. Here's where things get revealing. QQQM's 35% crash is brutal. Imagine watching a third of your portfolio vanish during a multi-year tech downturn nightmare. In plain English, maximum drawdown is like watching a building crumble. It shows how far your portfolio can fall before hitting rock bottom. The bigger the drop, the scarier the ride down. But wait, there's more to this story. VV's 26% drawdown is notably smoother sailing. 9 points less pain means you'll sleep better when markets turn ugly. Here's the thing though, over a year underwater before breaking even, that's 404 days of watching your investment tread water, hoping for recovery. Let's take a closer look. VV took 427 days to recover, 23 days longer than QQQM. Smaller losses don't always mean faster comebacks in this game. In plain English, recovery days measure how fast you get back on track after a fall, like a marathon runner stumbling mid-race. The quicker you recover, the less time you're behind. But that's not the whole picture. QQQM's 23% volatility means significant price swings. You're in for a wild ride in both directions here. Let's see how this plays out. VV's 17% volatility means steadier returns. 6 percentage points less turbulence keeps your portfolio from swinging wildly up and down. Here's what really matters. QQQM's 14% volatility means bigger price swings recently. You're getting a bumpier ride compared to its steadier competitor right now. In plain English, volatility is like choosing your roller coaster. Higher numbers mean wilder swings in your portfolio. Some investors crave that adrenaline rush, while others prefer the gentle, predictable ride. But hold on a second. Time to place your bets. Which ETF comes out on top here? Let's unpack this a bit. VV's riding smoother with 10% volatility. That's 4 percentage points less wild swings than QQQM over the past month. Here's the key takeaway. QQQM costs you 15 cents per $100 invested annually. That's 0.15%, which is pretty reasonable for market exposure. Now let's flip the script. VV's 0.04% expense ratio means you're keeping more of your returns. That's a massive cost advantage worth serious money over time. In plain English, think of expense ratios as couch change. VV's asking for pennies per $100, while QQQM wants nickels. Doesn't sound like much, but over decades, those nickels really add up. Let's get into the weeds here. QQQM is putting over half its money, 53%, on technology alone. That's massive sector concentration, meaning tech swings dictate your returns. Now let's shift gears and look at VV keeps tech at 35%. That's 18 points lighter than competitors, spreading risk across more sectors instead of betting everything on one. But here's where it gets interesting. QQQM basically ignores banks and finance completely. Just 0.31% exposure means this fund's all about tech, not traditional finance. In plain English, think of it like ordering pizza. QQQM gives you one massive tech slice and barely anything else. VV? That's a balanced meal with proper portions across every sector. Let's dig into the details. VV's 13% allocation to financials means real exposure to banks and insurance. That's proper diversification, not just token holdings. Here's where the story takes a turn. QQQM keeps it tight with just 103 stocks. Fewer holdings means each company gets a bigger slice of your money. In plain English, here's the thing about diversification. QQQM puts your money into 103 companies, while VV spreads across 456. It's the classic egg basket problem. Fewer baskets, bigger mess if one drops. QQQM delivered huge gains, but crashed hard with 35% drawdown and high volatility. Meanwhile, VV gave you 94% returns over 5 years, with better risk control and lower fees. That's what consistency looks like. Now for the real question. VV spreads your risk across 456 stocks. That's over 4 times more diversification than QQQM gives you. Let's dig into the details. QQQM refreshes about a quarter of its holdings annually. That's relatively low turnover, meaning fewer taxable events for you. Here's where things get revealing. VV's 2% turnover means they're barely touching their portfolio. True buy and hold investing with almost zero trading churn. In plain English, turnover's like dance partners. QQQM constantly swaps its holdings while VV keeps the same crew year after year. All that trading? It means higher costs and bigger tax bills eating into your returns. But wait, there's more to this story. Over half the funds in tech, when that sector tanks, you're feeling every bit of the pain amplified. Here's the thing though. VV's 35% tech stake leaves breathing room for diversification, with financial services at 13% balancing the portfolio nicely. Let's take a closer look. That 23% volatility comes from sector concentration. Fewer baskets mean bigger swings when things move. Buckle up for the ride. In plain English, here's concentration risk in action. When storm clouds gather over tech, QQQM gets absolutely soaked since it's tech-heavy. Meanwhile, VV stays drier with its umbrellas spread across multiple sectors. But that's not the whole picture. VV's 17% volatility comes from spreading across 456 stocks. Diversification smooths out the wild swings you'd see in concentrated portfolios. Let's see how this plays out. Here's the counterintuitive truth. QQQM dropped harder at 35%, but recovered 23 days faster than VV's smaller 26% fall. Here's what really matters. Tech's focused bet pays off faster. QQQM bounces back in 404 days, while VV's diversification slows its recovery timeline. In plain English, here's the rocket blast-off principle in action. Concentrated funds take the express elevator down during crashes, but they're first in line when the market rebounds. Diversified funds, they cushion your fall, but take the scenic route back up. But hold on a second. That $110 difference compounds year after year. VV's lower fee means you're keeping more of your money working for you. Let's unpack this a bit. That 0.15% cost is reasonable for tracking the NASDAQ 100. Definitely cheaper than what most actively managed funds charge you. Here's the key takeaway. VVV's 0.04% fee is incredibly cheap. Vanguard's massive scale lets them offer one of the lowest costs in the market. In plain English, fees are like taxes on your investments. You're paying them every single year, bull market or bear market. The less you pay, the more wealth you keep. But there's a catch. QQQM crushed it with a 135% return versus VV's 87%. Tech concentration paid off big when the sector rallied hard. Let's get into the weeds here. Over 5 years, QQQM's concentration edge shrinks dramatically. Just 14 percentage points separated from VV's broader diversification approach. Here's where things get revealing. Over 3 years, QQQM's winning with a 1.4 Sharpe ratio versus VV's 1.2, but they're dead even at 0.6 over 5 years. In plain English, here's why time horizon matters. Like a marathon runner, QQQM sprints early and wins short races, but VV's endurance pays off over the long haul. Choose based on your timeline. Let's zoom in on this. QQQM's higher Sortino ratio means it's better at limiting downside losses. Tech concentration actually protects you when things drop. QQQM brings 23% volatility, chasing higher returns, while VV's 17% volatility focuses on steadier, smoother compounding over time. Here's where the story takes a turn. Turnover tells you everything. QQQM's 27% means they're actively managing positions, while VV's 2% is pure buy and hold indexing. In plain English, think of it like a chess match. QQQM's actively making tactical moves, adjusting positions constantly, while VV just sits back playing the long game without ever touching its pieces. Now let's put this in perspective. Your choice here boils down to what keeps you up at night, chasing tech gains or sleeping soundly through market storms. Here's your choice. Chase tech's explosive growth with QQQM, or anchor your portfolio with VV's market-wide stability. Let's dig into the details. Both funds delivered nearly identical results, 18% versus 17%, showing that neither strategy holds a clear edge right now. In plain English, here's the seesaw choice. QQQM tips toward tech-fueled gains but wobbles hard when markets fall. VV, it's your steady, balanced ride, less drama, smoother sailing through market storms. Now let's put this in perspective. So which one's right for you? QQQM. If you're chasing tech growth, VV if you want broader, steadier returns long-term. In plain English, here's your road trip guide to matching your investment style. QQQM's the adrenaline rush. Fast gains but stomach-churning drops. VV's your steady cruise. Smoother ride, fewer surprises along the way. Here's the thing though, the usual legal stuff. Do your own research, consult professionals. Past performance doesn't guarantee future results. Here's the key takeaway. That's a wrap on this ETF breakdown. Hit subscribe if you want more data-driven investment analysis like this every week.